It's time for the Phil Ferguson Show.
This is Phil Ferguson, and you are listening to The Phil Ferguson Show. I think this is episode 457. Confused myself at the very beginning. We have a lot to go over today. I have a segment about 401ks and generally how they work. Quick reminder, and I'm pretty sure I have this in the segment, I can no longer give specific personalized investment advice in 401ks that are held outside of TD Ameritrade and are not managed by me. I've gone over this many times, so I'm not going to belabor it here. But in the segment, my intention is to give general information about how 401ks work. I can still tell you that basic information, and hopefully you find that helpful, whether you're moving a 401k now or at some point in the future, because there's a lot of confusion and it's complicated. So there's that. I have a segment on commodities. I had a flurry of people that wanted to have money in commodities or more money in commodities last year. And I think I fought back everybody and talked them out of it for the reasons I talk about in the segment. And it looks like we were all very lucky that that was the path that everybody went with. It's not pouring money into commodities when the stock market was down, because commodities have had a very difficult time since then. And I also discuss a company called Invesco. They have decided to just close several different mutual funds and many ETFs. And I happen to get a document from them that I talk about why they did it. It's basically the shortest. They weren't making enough money with it. But we talk about that, and they did a rare move. Instead of moving your money into a new fund, for a lot of it, they just sent people cash. They said, we give up. Here's your cash, which I guess is great, because if you can't do a good job, give me my money back. Yeah, it's my money. So all of that is coming up. A couple things in the news today, the last few days. Proud Boys have been, several of them, 4 of them so far, have been found guilty of seditious conspiracy. So that's cool. I think the sentence is up to 20 years in prison, which in my opinion is not long enough, at least in relationship to what some people get for carrying a few grams of drugs. Not generally a topic for the show, but there you have it. Let's see. Trump is still running for president. There's things in the economy that are rough. I kind of like the idea that I've heard a rolling recession. Often when the economy changes, there's a little patch of time where things go poorly and the gross domestic product goes down for a couple of quarters or longer, and the stock market goes down. And of course, the stock market went down 19.9%, 19.5% as measured by the S&P 500 for all of calendar year 2022. And so far in 2023, it's been up. So that's nice. Will we have a recession? I don't know. Kind of seems like no, or maybe yes, but a little teeny one. So keep in mind, though, that the stock market is a leading indicator of a recession, which means that the stock market generally goes down before the economy goes down, because often people get spooked before the bad things happen. So if you like the idea of buying and selling, timing the market, the time to have sold was when things were great and before the market went down. But nobody wants to do that. I remember a year and a half, 2 years ago, the biggest fight I would get with any of my clients is when I would say, let's move 3 or 4% more into bonds this year because you're a year closer to retirement. And when you can look at your portfolio and say, I just made 28%. Why would I do that? Because you just made 28%. So you have to fight that human nature. So almost always, if the market goes down before a recession, or if the market goes down in relationship to a recession, it's before the recession. So if you're worried about it now, there's a possibility that you're just way too late. Of course, this could be laughably bad analysis in a year or two if I'm wickedly wrong, and I can be. That's why we design a plan, and we stick to a plan year in, year out. And the plan is designed to make you a generous amount of money when the markets go up, and hopefully not to lose too much when the market goes down. But if you're really, really young, 20s, 30s, maybe even early 40s, in my opinion, you should be pretty much all in stocks and make the most money while you can. It doesn't matter if your portfolio goes down 20% or 40% or 50% if that money is for retirement. So don't sweat that too much. Some banks have been struggling, particularly medium-sized banks, and it sounds like there's a 1-2 punch of things that have hit these banks. Maybe there's 3 things. They're medium-sized banks. I don't know what the definition is, but there was a new law passed a couple of years ago by Republicans and signed by Trump that allowed not the major banks, like the top 5 or 10 banks, but banks below that size don't have to do a thing called mark to market. So they can own bonds, particularly in this case, long-term bonds that they say, hey, we're not going to sell these. And so we paid $1 million for these bonds. Sure, the current market value says they're worth 500,000 or 600,000 or 700,000, but we're not selling them. We're going to hold them to maturity, and we don't have to mark them. We don't have to report that their price is the new lower price that is actual reality today. Really, really bad idea. It's a stupid exception to grant banks. It's a stupid thing for banks to take advantage of it, and it should be that law should be fixed. So you have banks that apparently didn't know the basics about bonds like you do because you're listening to this show. Really long-term bonds, 10, 20, 30-year bonds. If interest rates go up, you can get whacked hard, and they have. Now, most of these banks, long bonds aren't the only thing that they own, and some other intermediate-term bonds and even short-term bonds have gone down. And they'll be able to replace those rolling forward as things go along, but they might have a struggle. But then you you add on top of that, people going and taking their money out of the bank. You get, what is a bank run? It's a classic bank run. And of course, the basic idea of a bank is they take your money and give you some paltry interest on it, and then they lend it to somebody else to help keep the economy going along. Well, when you show up and say, I want my money out, they give it to you. But when a bunch of people show up and want their money out all at the same time, it's it's the classic movie. What was that thing called? Oh yeah, It's a Wonderful Life, right? Everybody goes to the bank to get the cash. Well, the cash is not there. And so what happens is you have a bank run. That's what it is. Everyone wants their cash, but the cash is not there. Well, banks are required to maintain a certain amount of cash and document a certain amount of investments on an ongoing basis. And when the cash is not enough, they have to start to sell some of the investments that they have. Well, when you have to start being forced to sell investments that are down today that may likely cover or you can recover from slowly and gradually over time by repairing your investment portfolio, you suddenly have to sell a bunch of stuff at a discount. Now you don't have enough on hand to pay people or to meet the minimum holding requirements for cash that banks have to meet, and the bank starts to struggle. It doesn't mean that the bank is broke. It means it doesn't have enough cash in its pocket right now to hand out what's being asked of it, and it creates this pinch point. Well, it has been brought up to me a couple of times that there are news stories about Schwab. Schwab has a bank. I don't know a whole lot about it. I've read a couple of articles. I never know what's going to happen in the future. But the short version of this, I'm not worried. Here's a couple of reasons. One, Schwab is much bigger than the Schwab Bank. So there's that. Does Schwab have long-term bonds that have lost them a bunch of money? I'm sure they do. Apparently, nobody knew that long-term bonds were going to collapse when interest rates went up, which is hysterical. But are they going to suffer? Probably. How much are they going to suffer? I don't know. And Schwab Bank, just like any other bank, is covered by FDIC insurance, $250,000 per account. And if you're investing with Schwab, your investments have nothing to do with the bank. The bank is about if you have a checking account or a savings account or a loan or a margin loan, any of that stuff. None of that I deal with, any of that fancy stuff. So it doesn't really affect you, even if there was a problem. But again, if there was a problem, there's FDIC insurance. Now, your investments at Schwab, I've done a show on this recently, which affects all brokerage firms. The money you invest in a traditional brokerage firm, I'm not including online and cutesy apps for your phone in this part of this discussion. They do not own your money. They do not have your money as their money like a bank does. A bank literally takes, you deposit $1 million, they literally take your money and they invest it. And they make money on that $1 million while your $1 million sits in the bank. A brokerage firm does not do that. A brokerage firm makes money on charging you for a trade. They make money with fees in the accounts. They make money by selling you packages of data and high-speed information so you can be a day trader. There's all kinds of ways brokerage firms make money, but that's almost always transactional or interest on a loan if you happen to have a loan with them. But your money is not held per se by Schwab. It's not their money. It's your money. It's always in your name. So Schwab can't get to it. They can't use it to pay debts if they owe more than they have, which I don't think is the case. And then since I use Vanguard index funds, and this is true with all mutual funds, not only does Schwab not have your money, Vanguard technically doesn't even have your money either, because every mutual fund, the money is held by a third-party trust or a foundation kind of structure. So the money's not held by Schwab, it's not held by Vanguard, it's held by the trust. And so every different mutual fund that you have has a different trust, and it can't be used by Vanguard or by Schwab to pay any bills if they owe somebody. So you have all these layers, and then you also have SIPC insurance, which also protects your money in your accounts and in these trusts. And then I was just looking on the Schwab website, they have another $600 million of SIPC insurance that they're paying extra for on top of what is required, which I think is $500,000 per account. But that would really almost only affect if there's like complete major fraud, not because they messed up, like they're actually stealing your money. That's not theirs to have, so it can't be paid for debt. So anyway, just some thoughts on that. Hesitant to bring it up, but I also don't want anyone to think that I'm not discussing it because it's stories. A couple of the links that I got, of course, are on websites that promote cryptocurrencies. So, take that for what it's worth. If it's on a website that promotes cryptocurrencies or has pop-up ads that tell you should buy gold or how awful fiat currency is, they might feel like there's an advantage for them for promoting something that makes everyone spooked and you want to run to them with your money. So be a good skeptic. Pay attention to where the information is coming from. I can't promise you that any company is going to be solid and survive in the future. But the nice thing with the brokerage firm and mutual funds and Vanguard index funds and all mutual funds, the money has layers and layers of protection. So I don't think it's a big worry. If you do think it's a big worry, call me, talk to me, ask me questions, send me an email, phil@polarisfinancialplanning.com if you're so interested. And I think that's it for the introductory thing. We'll take a quick break and get onto all these fun segments about money and how investments work. The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions. I was thinking it was time to do a segment. We've talked about this before, but on 401ks and how they work. And part of the reason for doing this, I'm going to backtrack a little bit from last year. For anyone who's a new listener, welcome, by the way. 401ks. The Department of Labor, a couple of years ago, made a rule that basically said it was illegal. They use the word forbidden, but illegal for an advisor like Phil with a company like Polaris Financial Planning to make a recommendation that you should move your 401k money into an IRA. Why, you might ask? Great question. And it's actually has some rationale behind it, although I disagree with their decision. But the idea is that your money was in the 401k, whether it was doing great or awful, I don't know, it was in the 401k, but you weren't paying an advisor. If I recommend that you move it from the 401k into an IRA that I manage, it would be added to the assets under management, as they say in the biz, AUM, assets under management, and then I would be collecting a fee from you. And so they said that that's an inherent conflict of interest because I'm recommending you move money from where you're not paying me to where you are paying me. I get it. They're trying to help people out. I think what they could have done, what they should have done, is something like you have to re-sign the contract, or you have to sign a document that says that you understand that you're going to be paying the advisor, because everything else that you have invested with your advisor or me in specific, you're already paying, and you already knew that, or at least I hope you knew that. I mean, my clients know that, but if you're using somebody else, you're paying them one way or the other, and that should be clearly disclosed. Another side story. So what that created was a problem where I can't make that recommendation. The industry objected, and I think I'm up to date on what's going on here. The Department of Labor then created a process to claim an exemption from the rule, or an exception from the rule. I'm not sure that it matters. And there's these 8 things that you have to do as the advisor to document that you've done all these steps, and now you can do something that they've called prohibited, which I call illegal. So you can do something illegal as long as you follow some additional steps. I don't like that. I don't like that a lot. That's fuckery. And so I thought, okay, well, I don't want to bother with that. And part of the reason is that even if I tell someone, just leave the money in the 401k because it's better for you, I've now rendered an opinion, and I have to document how did I come to that conclusion. So if I make a recommendation to move the money, or if I don't make a recommendation to move the money, I have to document why I said not to move the money. Sounds like a lot of headache and a lot of pain. And thankfully for Phil, I have a lot of clients. I still get occasional new clients from talking, from tabling at conventions, from this podcast. So I'm good. I don't need this extra level of pain and agony. But when I was talking to my compliance company, they also suggested that I don't even give advice on 401ks, what to do with them inside of the 401k. Like, I could consider your total portfolio, your age, the funds that are available to you, and recommend the asset allocation in all those funds. I used to do that. For 2 decades plus, I did that. But now I can't, because if I tell you put more in stock or more in bonds, and then at some point you switch jobs, and then you say, hey, Phil, I want to move this money over to an IRA that you manage, I have now created a problem that the Department of Labor could pounce on me for, because by previously giving you information on what to do with the money in your 401k, I have proven empirically, mathematically, that I don't need to be paid to give you advice. What? So now if I recommend that you move it over and I charge you, I'm still in violation. Even if I do the exemption, I'm in violation because I was already doing all of that for you for free. And now I am going to charge you. So the whole thing has created a situation for me, and other advisors can handle this differently. Other companies can handle this differently. And maybe I'm doing it wrong. And if I find out there's a better way for me, I'll change it. But I'm in a position that if someone calls me and says, hey, Phil, I've got this 401k, what should I do with it? What I have to tell you is that I will not render an opinion, positive or negative. I will not suggest that you should move it or shouldn't move it. I can't give you any personalized investment advice. I can't give you any recommendations personally on what you should do with your 401k money, whether you should move it, whether you should keep it, whether you should invest in this fund or that fund. I'm not doing any of that. And with all that being said, you might be thinking, well, what the fuck are you talking about now? Why are you bringing this up? So here's the deal. I can't give you any personalized information to you, but I can give general information about what a 401k is or how it works, because these are just facts out in the world. They're not me rendering opinions. Some things are opinions, but as long as they're around the general process. So here's a couple of things that might help you. Generally speaking, I think it's a good idea for most people, not necessarily you specifically, but for most people, when you leave a job, if you have a 401k or a 403b or a TSP, generally speaking, it's better for you to move it into an IRA. Why, you might ask? Well, there's a couple of reasons. One, your employer can change the funds available to you in your 401k at any time. They might provide you notice. I don't know if they have to, but there's probably some rule that they have to give you 2 or 3 months notice, and your funds will be what they say is mapped over to the new funds. In some cases, particularly with small companies, they might have a pretty nice 401k, but the company, the employer, is out money every year to the management company, to the advisor, to the custodian that holds all of the assets, because everybody wants to make money and the company's paying part of that. Another provider can come along, another custodian can come along and say, hey, we'll do all that same work, Mr. Employer, and it won't cost you a penny. As far as you're concerned, it's all free to you. And the employer can change your 401k plan. Back many years ago when I worked for the man, I had that happen several different times. If you've been doing this for a while, you've probably experienced it yourself, where you get a letter from HR and it says, we're going to go from company A to company B. Why is the company doing that? You'd have to dig and find out. But like a lot of things, it's about the money. And switching from company A, which may have been fantastic for you, to company B might have funds that have higher expense ratios. They might have a advisor that comes and talks to you to suggest things to you that you should have to diversify your portfolio. And maybe some of those ideas are good, but now you have to evaluate them. The company removes that expense from their books and they make more profits, but those expenses have to be built in somewhere, unless custodian B is somehow inherently more efficient. They're probably not. But what they're doing is they're collecting the fees from you in some way and therefore not charging the employer. So once again, in this system, everything, you pay for it. So just, it's just the way of the world. You want something, you have to pay for it. But it's kind of slimy and it can be hidden, and I don't like a lot of that stuff. So if you have a 401k and you leave your job, like I said, I recommend that you roll it over. You can hire an advisor. You can hire Phil or not hire Phil, assuming you have at least $2 million at this point in time for assets under management. You can send the money somewhere else. Why do that? You have much greater control of which funds that you own, of which funds that you buy, of which funds that you sell. And at no point in time, everything has exceptions, but at no point in time, the company is going to say, we're closing all the funds, or we're going to move all your money from these funds to other funds that have higher expense ratios. Fidelity, generally speaking, is not going to do that. Vanguard is not going to do that. Schwab is not going to do that. So you have better control and you can keep the funds that you chose in the allocations and the ratios that you wanted. Additionally, you have way more choices. You might be able to pick from thousands of mutual funds or index funds, which might actually be slightly problematic because it could cause a little bit of panic and or anxiety for you, because now you can choose anything. You don't know what to choose. But you have all the choices. You probably have lower expenses, and you've reduced, if not eliminated, the risk of your investments being changed to some other investments that you might not have wanted that had higher expenses when the employer decides to change the custodian for the 401k plan. Okay, so there's that. Now, if you happen to be a client of Polaris Financial Planning and using me to help you move your 401k, if you call me and say, hey, Phil, should I move my 401k to Polaris Financial Planning? I will now have to tell you I can't render an opinion, and I'll send you an email saying I can't render an opinion, but you are free to do whatever you want with your own fucking money. So send it wherever you want. If that happens to be an IRA that I already manage at TD Ameritrade or in the future Schwab, so be it. You could let me know. That'd be nice. Otherwise, I just see when the money shows up. So there's that. If you have questions about how a 401k works, one of the things you can do is go to Investopedia and Google 401k Investopedia, and you can learn things from there. Inside of your 401k, of course, as noted, I can't give you specific investment advice that's to you, but in general, I can say with any account, whether Phil manages it or you manage it, if it's an IRA or a taxable account or a 401k, you want to have index funds. Now, that's my opinion. Different people can have different opinions, but hey, it's my podcast. I share my fucking opinion. Look for index funds. In the title, the description of the fund, it might say index or IDX or INDX or something like that. It may not. But small caveat, although I haven't seen it happen, I am not aware of any regulatory compliance law type stuff that would prevent a company from using the word index in describing their fund, even though it's not an index fund. Actually, I am aware because some companies will do a thing called Index Plus. So it's an index fund, but then they manage some of the stocks that are in the index fund. And in this topsy-turvy world of investments, as soon as you add some other thing that you're doing to the index fund, secondo me, in Italian, according to me, it's no longer a fucking index fund. It's now a managed fund because someone is making decisions on what to have and not have. This also applies to a new trending idea, often called personalized indexing, where you can pick an index fund and then change the weightings on a certain number of stocks, or if there's stocks you don't like for whatever reason, you can have them eliminated from your personal positions. And so now you don't have the index fund, you have the index fund modified by you for the personal index fund. So again, now it's defeating the purpose of being an index fund. The idea of the index fund is whatever that index follows, you own everything. And that's it. Yeah, so fucking easy. But the beauty of that is radically lower expense ratios. If you're in a taxable account, radically lower taxes. So there's a lot of benefits for index funds. So how can you find for sure and know that you have index funds in an account available to you? I recommend that you look for the expense ratio. If you work for somebody and they have an employer-sponsored plan, the custodian will create a list of mutual funds or investment options that you have. Look for the expense ratio. Now, I am not 100% sure of every single item that's included in the expense ratio, but every company follows the same law. So if you look at a mutual fund and it says the expense ratio is 1.2, that's pretty high. If it says 3, that's really fucking high and should avoid that like the plague. If it says 0.6, that's a fairly efficiently managed fund. Generally speaking, if it's 0.2, 0.1, or even lower, it's probably really high probability to be an index fund. And that's what you want to look for. Now, What percentage should you have in stocks and bonds? It would follow, generally speaking, the same guidelines I give out for any other account. In general, for people at large, you will have to take into consideration your own personal situation and adjust from there. Other thoughts on a 401k. People ask all the time, and I just had a wonderful conversation with somebody which inspired this whole segment. People ask me, when should I put money in the 401k? When should I put money in the 403b? What part of the year? Should I put more in the beginning or more in the end? Okay, without considering other outside trickery, confusion things, generally speaking, in any given time period, the sooner you invest, the better. It's better to invest a whole bunch of money at 25 instead of 35. It's better to invest money in January than in December of a given calendar year. Not because December is bad, but because most years, 8 out of 10, 85 out of 100, the U.S. stock market goes up. And so if you're investing in January, you have a possibility, a high probability, an average return during the year of 10% that you don't get in December. So if you have the means, you could consider front-loading your annual contributions to your 401k. Now, keep in mind, you may not have sufficient cash flow available to do this. You need to have income from another source, a spouse that's working, cash sitting around on hand that probably wasn't doing anything anyway, and so it might not be the right thing for you. Some employer plans will limit what percentage of your pay you can put in. I've had employers many years ago that would limit it to 100%. So some of us would put 100%, and for the first 2 or 3 or 4 or 5 months of the year, depending on your income level, you would not get any money out of your check, but it would go and fully load the 401k. Another thing to keep in mind is that if your employer provides a match, and very cool if they do, I call that free money. They can do it all kinds of ways. They can say up to 8% will match dollar for dollar. They can say up to 6% of what you put in at a rate of 50%, they'll match what you put in up till 3%. So they're putting in 3% at 50% of the rate that you put in up to 6%. So meaning if you put in 4%, they're going to give you 2. If there is free money, matching money available, and you do not collect it, you have fucked up. You want to get 100% of all free money that is available to you. There is the possibility that if you front load your contributions to the 401k, let's say it takes you 6 months to do that, and you've maxed out your 401k for this calendar year. If the employer provides you a match, but they only match in a given pay period that you put in money, you now may lose half of the matching money. Do not lose the matching money. It's 100% free. So now the question is, okay, well, how fast could I put in money to then put in the right amount to get all of the match until 12/31 of that year? And you might have to do some algebra. It's a little bit trickier math calculation. Of course, you could just calculate how to put it in equally every pay period, and so that at the end of the year, you've maxed out the plan. The difference between that and putting it all in the beginning of the year is a couple percent for that year's contributions. May not be a big enough amount of money for you to mess with it and for you to have this conversation and hassle with your HR department. That's only something you can decide. But from a purely mathematical perspective, front load as much as you can in a given year, change it to make sure that you get all of the free money. You will probably make a little bit more money in most years than by not doing it that way. But like I said, that's effort. That's complicated. It's a hassle. So it may not be right for you. Make sure you know how much you can put in. Make sure if you are 50 years old, the year in which you turn 50 years old, you get what's called a catch-up bonus. And I think that is currently $7,500 in addition to what you can normally put in your 401k, which gets us up close to something around $30,000. And that's not including any company contribution. So keep an eye on all of that. And that's a whole lot about 401ks. One other thing, because I just had this conversation. Generally speaking, you can't just take money out of the 401k while you work for that employer. Usually it requires a separation event, whether you retire or quit, or they fire or lay off you, or in some cases, if your company gets bought by another company, they will probably merge all of your 401k money into the 401k plan of the company that bought your company. Technically, what happens is your old 401k ends and your money rolls over into the new 401k. It is very likely in that kind of scenario that when your old employer's plan ends, there will be a window of time that you can then move your money from the 401k plan that ended into an IRA. So be on the lookout for that. If your company gets bought by another company and at some point they notify you they're going to move all of the 401k money from the company they bought into the 401k of the company that bought it, there's probably going to be a window for you to say, I don't want to put all the old 401k money in the new 401k, and you can roll it over into an IRA. Also, something that I hear a lot is that if you do a rollover from your 401k into an IRA or from a Roth 401k into a Roth IRA, that does not affect the annual contribution limits that you could make to an IRA. So let's say you qualify in every other way to put $6,000 into an IRA, but during this calendar year, you moved $100,000 from your 401k to your IRA. That's cool. That rollover in and of itself does not affect your ability to put $6,000 into your IRA. I think that's enough. 20 plus minutes on 401ks and how they work, what your options are, what your choices are. And hopefully that helps somebody. If you have questions or I explain something poorly or incorrectly, because it does happen, let me know. Send me an email, phil@polarisfinancialplanning.com. We're going to wrap this up and do something else now.
You're listening to The Bill Ferguson Show.
Hey you, it's me, Sarah Silverman. You know, lately I've noticed a lot of really sad, really long commercials on TV with like grossly sick, emaciated people from all over the world. And it turns out they look that way because they don't have food. And I know what you're thinking. If you don't like it, Silverman, TiVo past it. I did. You still see them. Especially because, like, I have a 48-inch plasma high-def TV, so every devastating image is in, like, brilliant, crisp, vivid, like they're in my apartment, you know. So how do I get these people out of my apartment, basically? And I think I figured it out. Like, all I have to do is end world hunger. And then I'm like, okay, how are you gonna end world hunger? And then it hit me. Sell the Vatican, feed the world. Think about it. We need a hero, and who is more primed to be our hero than the Pope? He's literally a caped crusader. What is the Vatican worth, like $500 billion? This is great. Sell the Vatican, take a big chunk of that money, build a gorgeous condominium for you and all of your friends to live in, all the amenities, swimming pool, tennis court, water slide. And with the money left over, feed the whole fucking world. You preach to live humbly, and I totally agree. So now maybe it's time for you to move out of your house that is a city. On an ego level alone, you will be the biggest hero in the history of ever. And by the way, any involvement in the Holocaust bygones. I know some of you out there are like, well, why don't those bums get a job like the rest of us? Well, did you know that the average Arby's employee in Ethiopia only gets paid nothing an hour because they don't have one. They don't have one. The bottom line is this. If you sell the Vatican and you take that money and you use it to feed every single human being on the planet, you will get crazy pussy. All the pussy. And I don't mean literally. That might not be your cup of tea. I don't know what your version of all the pussy is. But you'll get all the pussy. Amen.
I just came across something that was kind of weird, and I didn't fully understand it. I had to dig into it, and I thought, hey, you know what? Now that I've made all this effort and wasted all my time, I'll make a segment for you to enjoy. I happen to do charity work for, just say, an organization, and I help them balance their portfolio and invest in index funds. But there was a couple of different things that they own that I don't necessarily like that they had before I was involved, and that's cool. You can have a different strategy or plan and do just fine. Although, of course, I like mine better. But whatever. So one of the investments they had was a gold fund. I talked about gold and precious metals and all the reasons I don't like them. You're going to have to go find that somewhere else in a previous episode, or let me know. I can always cover it again. Not the point of this segment. So I went to do stuff for them ending March 31st. And this is now April, so it just takes a while to get around to things sometimes. And I noticed this ETF, which has the symbol DGL. DGL. You can go look it up yourself. Or can you? Because it went fucking poof. It disappeared. And I looked and I couldn't find a reason why or how. And my first thought, it probably got merged with another fund. And I've seen this happen before in real time. And it could make a great segment because a lot of times people don't understand that if you look at all the funds run by a company, and I'm going to mention the company here. In this case is Invesco. If they say something like, 80% of our funds are 4 or 5 stars from Morningstar's rating system. First of all, the 4 or 5 star thing is meaningless. So don't use that to pick funds. I'm telling you, it's a whole nother show segment that I've done before, and I can do again. Of course, if you want that, send me an email, phil@polarisfinancialplanning.com. So usually they'll just blend it into another fund, what they'll do is they'll kill bad funds. They'll kill underperforming funds, and their marketing material will correctly say that 80% of their funds are 4 or 5 star funds because they went and closed a whole bunch of the 1, 2, and 3 star funds, right? So now all that negative data just fucking disappears. It's just gone. It's kind of magical, honestly. In this case, what Invesco did, because I couldn't find the information, so I called Invesco, and I got transferred a couple of times, and I finally got to the person that had the information, and they even sent me the official letter that they sent to all of the retail customers because I'm a financial advisor. I don't know if they should have sent it to me, but they did, and I have it here. It doesn't really tell you a whole lot other than a couple of key things. One, there's a bunch of mutual funds that they closed, and there was even more ETFs that they closed. And when I say closed, they didn't fuck around, because my first thought was, okay, they have this fund. It's the Invesco DB Gold Fund. That what they would do is take all of the money and all the assets in the DB Gold Fund and merge it into like a commodities fund, because they also closed a DB Silver Fund. But no, they just said, fuck it, we're done. Here's everybody's money back. Which, okay, from a business perspective, I think that was stupid. Just between you and me, don't tell anybody. Because if they went into a different fund, at least they could keep your money. Now, maybe that's not really a possible thing to do with an ETF because of the way the rules are set up. I don't know. I've never seen an ETF close before. But in this case, they just gave you back all of the money. Now, gold funds don't, over long periods of time, generally don't make a whole lot of money. And again, another segment, another time. But if you had bought this fund at some point in the past, like 2019, 2020, you might have paid $45, $46 a share. Its last day, it was $51.96. That was what it was trading for. I don't know what the actual, what they call the net asset value was, because an ETF can trade at a price point that is above or below the net asset value of the investments owned within the ETF. But that data is no longer available because it's closed. So I know that they're going to pay out the full amount, but it was just kind of weird that they closed it. So they gave people a little bit of a notice, and then poof, it closed. But the really worrisome thing, where I just mentioned you might have bought it for a lower price. If you had bought this and held it, when they liquidate it, everything that you made is a gain. Now, it might be dividends from this year, if the fund had dividends, or it could be capital appreciation, but it would be outside of your control that the fund just went poof, and they closed it. And like I said, there's like 20 of them, 30 of them that they closed. And you are going to be responsible for any taxes that are created because of this event. And I'm not going to bore you with all of the details in their letter, but it basically says, we reviewed these and they don't seem to be what our customers want, and they don't seem to have a growth opportunity. Actually, let me go ahead and do that. See, client demand and trends in the market. Oh, this is the list of reasons why they're closing these. Strategic alignment with Invesco's stated areas of growth, current and future demand potential for each product, Invesco's capability to deliver competitive differentiation in the market, future growth expectations of each product. I think you can summarize that all to they weren't making money on these, or they were doing a really shitty job while making money, and they didn't want the embarrassing list of all of these funds and ETFs on their track record. So they just fucking closed them, and they cashed everybody out. So weird shit happens in the industry, and you would never know about this unless I tell you. In fact, I didn't even know about this, and I've done this 27 years. But Invesco closed a bunch of funds, and they closed a bunch of ETFs, and they just sent checks to everybody. Just said, here's all your money back. And for this fund, it was on March 3rd of 2023. And so when you go to do your 2023 taxes, you will have a tax statement, a tax document that shows how much money you made or didn't make in this fund. And so, yippee, so you might have a surprise tax bill, but that's just some fun on a randomly closed ETF and how it might affect you or the market.
You're listening to The Bill Ferguson Show.
I like how you call homosexuality an abomination.
I don't say homosexuality is an abomination, Mr. President. The Bible does.
Yes, it does. Leviticus
18:22.
chapter and verse. I wanted to ask you a couple of questions while I had you here. I'm interested in selling my youngest daughter into slavery, as sanctioned in Exodus 21:7. She's a Georgetown sophomore, speaks fluent Italian, always cleared the table when it was her turn. What would a good price for her be? While thinking about that, can I ask another? My chief of staff, Leo McGarry, insists on working on the Sabbath. Exodus 35:2 clearly says he should be put to death. Am I morally obligated to kill him myself, or is it okay to call the police? Here's one that's really important, because we've got a lot of sports fans in this town. Touching the skin of a dead pig makes one unclean, Leviticus 11:7. If they promise to wear gloves, can the Washington Redskins still play football? Can Notre Dame? Can West Point? Does the whole town really have to be together to stone my brother John for planting different crops side by side? Can I burn my mother in a small family gathering for wearing garments made from two different threads? Think about those questions, would you? One last thing. While you may be mistaking this for your monthly meeting of the ignorant tight-ass club, in this building when the president stands, nobody sits.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions. We're going to talk a little bit about commodities trading. Commodities as a hedge against inflation, as a hedge against market declines, things like that. It is something that last year, late of last year, when the market was down a lot, and for some people it was down 25%. It had recovered a little bit by the end of the year, and so the end of the year, the S&P 500 was down 19.5, but in the middle of the year it was down even more than that. And if you had all large cap growth, you could have been in the position where some of your funds were down 30, 35, or even more than 40%. And that is a period in time where people start to get a little twitchy and they want to hide or get out of the losses. Of course, it's already happened. So if you react to that, you run the risk, a very, very big and substantial and possibly painful risk, that you sell something right as you shouldn't because now you opened your quarterly statement. So, something like October 1st, and you're down in some of these funds 30, 40% last year. And I would now start to get the calls, at least I did last year, where people would say, hey, how can I stop this carnage? What are our hedges against inflation? Well, the best marketing gimmick ever was gold as a hedge against inflation. I've talked about that many times. I'm not going to belabor the point here. That's marketing gimmick, so it's not. Honestly, in the long run, the best place to be to offset the effects of inflation is in stocks, U.S. and international stocks. That's how you beat inflation, because the company's values go up. The revenue they bring in goes up. The profit margin they can make might go up with inflation because their prices went up. So everything goes up in scale. I'm not even talking about any nefarious bullshittery, which companies will often do, but just in general, stocks go up with the value increase or the value decrease of the dollar, of another currency. So you're hedged against inflation by having stocks. So you don't need to do anything bad. What you want now is you want some way to stop your account from going down. Well, now it's a problem, because if you look at something that's not in your investment plan, I have previously talked about TIPS and the TIPS ETF in particular. If you bought TIPS or any other bonds, government bonds, directly from the government, this doesn't apply. But if you went and bought them out on the street, if you invested in an ETF or a mutual fund, you are now subject to, how should we call this, possibly irrational behavior of other players in the market, because you're no longer buying something at a fixed cost from the government. In the case of TIPS, you're buying them for what they're trading for in the market. And what happened was people were scared and were willing to pay extra to not have the downside risk. Well, what happens when a whole bunch of people pay extra to not have the downside risk, and if you're not first to the party, you pay a lot for the perception that you don't have this risk. When the risk seems to go away, nobody wants to own those assets anymore, and they sell them at a rate that's higher than people want to buy them, so the price falls. I don't want to say collapses, but it can be pretty significant. And there are people that bought TIPS thinking, I'm going to make 7, 8, 9% interest, which you could have if you bought the limited amount that you could buy directly from the government. But if you bought a TIPS ETF, and I've already done this segment, so I'm not going to redo it here, you could have lost a whole bunch of money in like 6 to 9 months when the average investor thinks that the problem has gone away. Now, it may not have gone away, but they think that it's gone away, so no one wants tips anymore. So a couple of quick things. I pulled up, and I'm looking at the Dow Jones Industrial Commodities Index. The symbol is GSCI, and I was able to pull it up here on their website, the S&P Dow Jones Indices website. And for the last year, this index is down 29%. If you measure it from June of last year, so a little bit less than a year, 11 months, give or take, less than 12 months at least, it's down 33%. If you look at it from October 1st, let's see, you got your statement, and let's see, the first week of October, you got your statement, you bought it. It was 658, and now it's 543. I don't know how much that is off the top of my head. 15-20% loss. And that's at the same time period where now stocks maybe went down too much and started to go up. And so you bought something to protect yourself from stock losses, and stocks went up, and now your commodity index went down. Oh my goodness. So you lose 20, 25, 30% in stocks, move money out of there into the commodities, and then you lose another 20, 30, 33% there. So you got fucked twice. That's one of the downsides of timing. It can be very, very difficult. Now I'm going to look at this. Again, I'm still at the Dow Jones. The performance per year on average of this for the last 10 years, this is as far as this chart goes on this website. The average annual return with dividends, pretty sure this includes dividends. It's the total return. Let's go with it includes dividends. The average annual return is minus 1.35% per year for 10 years. Now, this is the index. This is not an actual fund that's investing and doing this stuff. Maybe this is. Is this an ETF? I don't know. But it could be lower for you if you have a fund that has high expenses. So maybe this is a best case scenario. For 10 years, you lost 1.35% annualized. Yeah, that's 1.35% per year. So you're down like 10, 15, 20%. Does that work out mathematically? Let's see. It was 615 10 years ago, and it's 543. Yeah. So you lost 1.35% per year compounded. Not a huge effect compounding over 10 years, but you're looking at 15, 18% loss for 10 years of investing. Yes, that can happen in stocks. You can have long time periods where you don't make much, but generally not this bad. Not this bad at all. And so now I want to look and see if I can find this other data that was longer. Yes, here it is. Of course, our old friend Morningstar. The longer data that's available is the Bloomberg Commodity Total Return in US dollars. Now, I know that includes dividends, but that data is not generally available unless you pay for it, and I'm not paying for it. I'm not even asking because I'm sure it's going to be a lot of money. But Morningstar has paid for it, and so again, I'm at Morningstar.com, and I pulled up the Vanguard Commodity Strategy Admiral shares. So it's a mutual fund, so I can know what I'm comparing. The symbol for that is VCMDX. And since the peak, a little less than a year ago, this fund is down 20, 25%. So you could have created a situation for yourself where not only were you not protecting yourself from inflation, you were doubling down on pain, I guess, because you lost money for half the year, 3/4 of the year in stocks, took money out of stocks, especially large cap growth stocks, and said, hey, commodities are a hedge against inflation. They always talk about having commodities in your portfolio. Now, if you decide to have a percentage, 5%, 10% of commodities in your portfolio, that might actually work or be beneficial, or at least better than what I'm talking about here. When you change your plan, when you change what you're doing, so if you're investing in stocks and you say, oh my God, they're down a whole bunch. No, I'm going to change what I'm investing in, and you switch to commodities. Now you're market timing. When you're market timing, often things don't go well. If you had commodities in your portfolio, they might have actually gone up when the stocks went down. because everyone was worried about inflation and the market and the economy. So people rush into things like commodities from time to time, which is one of the problems. They're very volatile. So if you had already lost money in stocks and then went to commodities, you could have lost 25 to 35, 40% on stocks and then switched over to commodities and now lost another 25 to 33% of your money. That's why you can't market time. You just can't. And maybe every once in a while you could get it right, but most people are going to get it wrong. And the reason I say most people, and I can say this with confidence, is part of the reason the price of commodities was so high is because everyone was rushing into them. And so most people, or more than previously, are buying commodities, pushing up the prices at the very time that the commodity prices are at their highest because people are buying them. So it's this weird thing that most people, especially if you're inexperienced, most people are buying the most at the time the price is the highest because that's when the price is the highest. The demand is high, so the price goes up. When the demand goes down and the price falls, if you then want to sell it, you lose again. And that's, professionals that are doing this, or if you have an allocation in commodities, you are in it when it goes up, but you're also in it when it goes down, but you didn't get hit. I guess, I think it's clear. I hope it's clear. But when I pulled up this data from Morningstar against this Vanguard fund, it does have 15-year data for the Bloomberg Commodities Index. And it says that the index per year for the last 15 years ending May 2nd, the time I'm recording this, although the show may go out a little later, is commodities are down 5.15% per year. Huge volatility in the meantime. And in a given year, it can go up a lot. It can go down a lot. It has volatility like the stock market. I don't know that it's bigger, but it might be bigger than the total stock market. Probably not bigger than individual stocks, but this is not an individual thing. It's all commodities. But the problem is, and this is why I don't have it as part of the index, when you look over long periods of time, 15 years in this case, 20 years, 25 years, you go back far enough, you can find where commodities do make money. But when you look back 30, 40, 50 years of history and all this data, what you tend to get is commodities return about inflation. And that's where they came up with the gold as a hedge against inflation. In 50 years or 100 years, whatever you paid for the commodities or whatever you paid for the gold, it's going to be worth about the same minus any trading, transactional, tax consequences, storage consequences, whatever. So owning commodities is expensive. People often buy commodities, they're trying to get it in at the right time and get out at the right time. I don't know when that is, so I don't do it. The performance is terrible in the long run. I don't do it. Why would I take stock market like volatility and lose 5% per year for the last 15 years? I'm not interested in it. If that's something you want to do, because that's probably something that I don't do that is, a standard in the industry is having 5 or 10% or more of clients' money in commodities in general or gold in general. And this is the reason I don't. I've not been compelled enough by any other evidence that I'm missing out on something. So the returns in the long run are horrible. The returns in the short run are highly volatile. And it doesn't really get you a whole lot. You could make the argument that from time to time commodities pop like they did this last year. Well, the first half of the year, as long as you constantly monitor it and adjust it. But then again, you're doing the market timing. I don't want to do the market timing. I don't want you to do the market timing. The data suggests for most people, market timing doesn't work. So don't do it. But, this is just some thoughts about commodities. So for the people that had talked to me in the summer or the fall or even the winter of last year in 2022, and I think successfully, I convinced everyone not to do it. You're welcome. So for all those people that thought buying commodities last year was a really good idea, and I didn't have this data a year ago, of course, but I've known in history when something goes up a whole lot all of a sudden, there can be a payback due. Commodities don't make much in the long run. So if they make a whole bunch of money in the short run, you gotta watch out because the bill may come due. And that's exactly what happened with these 20, 25, 28, 33% losses, depending on the date that you cherry pick in the very short run. So if you took money out of losing stocks and then put it into commodities, you lost again, a second time. Don't market time. If you want commodities to be a part of your portfolio, that's fine, but it should always be a part of your portfolio. I think I'm better off avoiding it, but you know what? Maybe I'm mathematically wrong. But anyway, that's some thoughts on commodities and how they've done in the last 10, 12 months and how they've done in the last 15 years. Not good. It's not good. Not a good place to invest. Anyway, enough of that. We'll take a break and go on with the rest of the show. Of course, thank you so much for listening to this little podcast, The Phil Ferguson Show. I greatly appreciate it. I realized after I did the recording for the beginning segment, so long ago in this podcast, that I actually wanted to talk about something else that has to do with Schwab. As you probably know, as a regular listener, Schwab bought TD Ameritrade a couple of years ago. I'm thinking in the ballpark of 3. I have recently been informed by some people who are not clients that have conventional retail accounts at TD Ameritrade that they are now receiving documents asking them to go log on at Schwab. I don't know exactly what's going on with that because retail is different than institutional. And Schwab is converting TD Ameritrade accounts kind of in the very way that I said they would at the very beginning. The first thing was TD Bank, and then they wanted to switch over people that did a lot of trading or used very expensive flows of information so they could organize that because they make more money on that. And then one of the very last things to move over, which apparently this might be the very last thing that they move over, is clients that have an outside advisor. And hopefully Schwab doesn't get any crazy ideas and want to steal clients from advisors like Vanguard did like 15, 18 years ago. So things are moving to Schwab. You're going to start getting letters from Schwab. I have more webinars coming up from Schwab/TD Ameritrade coming up, and I'll give you information as I think is appropriate for the listeners. Just a reminder, this is now, if you're listening to this closely after it came out, it's May of 23. My understanding is that somewhere around June 1st, Schwab is going to create clones of every single account held by the institutional part of TD Ameritrade, people that use advisors. So for a little bit of time, you're going to have 2 accounts running in parallel. One at TD Ameritrade, and it will look just like it's always looked, and you might not even know that there's a Schwab account other than me telling you. But there's going to also be a Schwab account. And the purpose of this is to run the system in tandem, the 2 different systems, to look for any variances, to look for where anything goes wrong, or to look for where the price is not executed correctly, or the trade is not executed, or money is not sent to you correctly. They're doing all of this. During this process, June through the beginning of September, you might get a statement from TD Ameritrade, and then you might get a statement from Schwab. It's okay. Hopefully it's clearly marked that this is for practice, or for mirroring, or for cloning, and just running through to make sure all bugs are eliminated before your accounts are actually custodied by Schwab instead of TD Ameritrade. But people who have retail accounts are getting letters saying, hey, go log on to Schwab. And apparently they are providing an opportunity for some or all of those retail customers to go ahead and move over earlier. I'm not aware of such an action at TD Ameritrade Institutional. And at this point in time, I'm going to say, don't do that. There's also a new deadline. You will be getting documents from TD Ameritrade saying, hey, by the way, your account will go to Schwab. I don't know the exact date, but it's coming pretty soon, or you may have already gotten one. My understanding of that document, again, from what they've told us is if you do nothing, they're going to move the money over to Schwab. And that's perfectly fine. That's what we want to happen. I don't want to be involved in filling out paperwork for 150 clients with 450 accounts. That's a lot of paperwork. I want it to be automatic, and I think you should too. So go for that. But that document would be an opportunity for you to opt out of moving your money to Schwab. You probably don't want to do that. I mean, if you don't want the money invested at TD Ameritrade, fine. If you don't want the money invested at Schwab, fine. But if you say, no, don't move it from TD Ameritrade to Schwab, you are now going to be an exception. And at some point when TDA closes, your account's going to go somewhere else or get liquidated. I don't know how that's going to work. Never done that before. Never heard about that before. So you want it to go. After May 19th, and this is a very important nuance, if you have an account open before May 19th, this does not apply to you. An account opened before May 19th will move to Schwab unless you opt out of the movement. Again, I don't think that's what you should do. You should just let it go. Let it move over and fix it, whatever's needed after that is all done. After May 19th, if you open an account, or if I open an account, or I help you open an account, you would have to go through an additional piece of paperwork. It's not a real big deal, 1 or 2 pages, that says, hey, by the way, I'm opening this account on or after May 19th, and I understand that it might go to Schwab, and yes, that's what I want it to do. So you have to opt in after May 19th. So with all that being said, and with the complications and potential extra work that might come up, and I'm got my fingers crossed this is going to be really easy and really smooth, I'm going to be kind of hesitant to open new accounts or to change anything between nowish and definitely between May 19th and definitely after June 1st until September. And that Labor Day, this Labor Day, whatever the holiday is in the first weekend of September, Friday night, Saturday, Sunday, and all day Monday is the official transfer of everything over to Schwab. Of course, since that's not, you're going to have money in TD Ameritrade for a few business days in September, and then in Schwab for the rest of September. You will get a statement from both companies. If there's any dividends or any activities or transactions that happen in your old TD Ameritrade account in October, you might get statements from both companies in October. At the end of the year, 12/31, you will probably get summary documents from both companies. Well, not probably, you will get summary documents from both companies that show how much you put in, how much moved, how much interest you made, and everything you would normally expect from the year-end document statements from a brokerage firm. You're going to get that from Schwab and from TD Ameritrade. After we get around January 1st of 24, you will likely get taxing documents where it applies, or any other documents that are legally required for the first several months of 2024. So you might need, I got to be careful with that. You probably will need tax documents from Schwab and from TD Ameritrade to take them to your accountant to do your taxes. So that's how it's all going to work out. I think they've got it under control. I think there's going to be very few problems, but there might be problems. The only real potential problem that I see, and the possibility of this is very small, but I mention it because I think it could be a problem, because it could happen to you, is that if there's any problem with withdrawals, like scheduled withdrawals. So if you get the money out on the 5th of every month, what happens on the 5th? If you get your money out on the 10th of the month, what happens? Does all of that transfer over? Does all that timing and scheduling of money coming out of your account and going to your bank going to be okay? I have every reason to think that it is, but if it's not, that's something that could materially affect you. So you should generally have a couple of months, 3-4 months of cash on hand in your local bank. What I can find very frustrating is when someone calls me on a Friday afternoon and they say, Phil, I've just written checks and I'm worried they're going to bounce because I don't have any money in my bank. but I have $3 million at TD Ameritrade. So one of the reasons to have money, one of the perks of having money is to not have to worry about that little nickel and dime shit. So don't out cheap yourself. I'm a pro at that. Every once in a while, I save so much money that I end up getting screwed. But make sure between now and September that you've got a couple of months of cash on hand at your local bank. So if there is a glitch in the system and it takes us a few days or a week, even a month to fix, you can still pay your bills. So keep that in mind. At Schwab, you will get new account numbers. If you have any money going from your TD Ameritrade account or your future Schwab account to some other location, your credit union, your bank, whatever it is that you're doing, that's expected all to still function just like it is. If you have a bank where you're pushing money to TD Ameritrade, the goal is for those to be updated, and your bank would automatically start sending it to the new location. Keep an eye on that. That's another weak point that it might break, where your bank might say, no, we don't allow that functionality, or we don't have a way to do that, or we've not created a way to do that. So if you have something like $500 going from your checking account to TD Ameritrade every month, when September comes, that may not work. Or it might work for a few months, and then in February or April of the following year, it won't work. So keep that in mind, that this stuff is, the goal is to have it all automatically move over. But pay attention. Make sure that you get the money out that you want every month or week, whenever you're getting it. Make sure any money going in or out of the accounts from any source or to any source is set up correctly and stays set up correctly. So just something to think about. I think that's it for now. More than enough. Over an hour of fun-packed adventure about money today. I'm going to wrap it up, and hopefully, I'll run into you somewhere out there in the world. Until then, ciao.